China has a full-blown energy crisis with actual energy shortages, and there's panic buying by Chinese state-owned enterprises that was ordered by Beijing in the last 4 to 6 weeks. So if you take a look at coal prices in China in the middle of your screen, the price of coal has gone parabolic. It's absolutely nuts. But the electricity shortage and the energy shortage in China actually started back in November 2020, almost a year ago. The YouTube channel China in Focus was actually covering with video and interviews of factory workers in many large factory districts and also residential areas close to factories, how they did not have electricity every single day, and there was already shortage problems back then. So it's actually been getting worse and worse since November 2020. Actually, at that time, when I was watching videos on it, a lot of people were blowing it off. So the Chinese Communist Party was denying it, and a lot of other sources were denying it, saying that it was overblown. But then we started seeing more and more stories about how the Chinese Communist Party, the central planners in Beijing, were allocating electricity differently than how the West expected them to. So go back and listen to the Elma Molman interview if you haven't. It's in the last couple weeks that I put out, and she talks about how the central planners in Beijing made a decision over the last 4 or 5 months saying that the electricity was going to be allocated to residential districts in Tier 1 cities, so that's Shanghai and Beijing, over the factories. And then more recently, the Chinese Communist Party ordered the energy and utility state-owned enterprises to import at all costs enough coal, natural gas, and oil supply. So that's why you're starting to see big spikes. If you actually go out and search China natural gas deals, there's large natural gas deals with US and European firms like Cheniere Energy and others over the last couple weeks. And China is planning on more than doubling its imports of natural gas and LNG in the very near future. So I put some of those deals in the boxes there. I highlighted some of them on your screen, but there's actually a lot of them. So yes, in the short term, the natural gas price may crash, but I predicted that the natural gas price back in early 2020, when a ton of natural gas supply came offline, that was only temporary, that it was only a matter of time. And I was writing articles for my patrons throughout all of 2020, and I was way more bullish at the time, long term, on natural gas than on oil, because I saw how much natural gas byproduct was coming offline here in the United States in shale oil. There was a lot of shale gas byproduct. It was coming offline. Now US LNG companies, so your Cheniere Energies, and there's some smaller ones, the larger integrateds like Chevron and Royal Dutch Shell, they're going to get a lot of really good deals from China because of this energy crisis. Because a lot of these coal-fired power plants that are in China, and China's kept building more and more coal-fired power plants, they can easily switch the costs. The time and cost to switch from coal to natural gas is not that expensive. I put a tweet from an analyst with a lot of good Asia analysis and good contacts in Asia. He's predicting that there's going to be a big spike in oil, another big spike in oil, in the not too distant future over the next 4 or 5 months because of the desperation, the panic buying that is coming out. And you can see that in the charts with the big spikes in oil, the big spikes in coal price, and the big spike in natural gas. I think a lot of that buying has to do with China. Also out of Germany and Europe, because of how Putin has dealt with his natural gas supply with Gazprom. And then also we have options traders that are now betting on $200 oil by the end of 2022. Now, I don't know if oil is going to get that high. If oil does, it's going to act as a tax on the real economy. It's going to crash the real economy, even worse than things are now. It's going to make a total mess of things. If oil goes to triple digits, say 120, 130, maybe even $140 a barrel, it's going to be an absolute disaster. If it goes to 200, it's going to totally wreck a lot of small business, working class, and poor people, and middle class people. It's going to be an absolute disaster if it gets that high. Because gas prices here in the United States, in many states, are already rising rapidly. Politicians and bureaucrats have kept putting more and more taxes on gasoline prices, even when oil prices were cheap in early 2020. Finally, if you like content like this and want to help keep content like this free so it doesn't all end up behind a paywall, or you want far more in-depth content research, financial education, and analysis than I provide in these short little free videos, there are now over 180 articles, charts, and audio podcasts behind the paywall, all for the cost of a Starbucks cup of coffee per month, only $5 a month. I think it is one of the best deals out there. And just in the last 18 or so weeks, there are 30 new articles out on a lot of interesting topics about global macro companies and sectors, gold mining, silver mining, precious metal royalty and streaming companies, and uranium. So if I could wrap up this short little video very quickly, the rig count here in the United States, it has risen, but a lot of the larger oil and natural gas companies are not in a big hurry to bring on a lot of new oil and natural gas supply. They need to generate free cash flow. They're not in a hurry to blow out their CapEx budgets. They're not in a hurry to take on a lot of debt. So far at least, you're not seeing the larger oil and natural gas companies rapidly bring on a lot of new oil and gas drilling rigs in the shale patch like what happened in the past. The increase in the rig count here in the United States, a lot of the increase is actually from smaller firms, smaller and medium-sized firms. It's not from the big guys, but the bigger players are starting to lock up long-term contracts with Chinese state-owned enterprise energy companies. You see Sinopec and some of the other companies are locking up longer deals. So those contracts are going to be win-win for both parties. So the Chinese state-owned enterprise companies will get a more secure long-term energy supply, and the American and European companies will get a locked-in profit. Because historically, as the energy prices rise, the rig count keeps increasing, and then energy prices crash. A smarter and well-run oil and energy company, say like a Chevron or a Royal Dutch Shell, if the natural gas price keeps rising, will start to hedge, will start to lock in more profits of profitable natural gas production at these prices. We'll start to negotiate more long-term LNG contracts. So I think LNG, even if there is a crash in the natural gas price, it's probably a buy the dip opportunity. Natural gas does have a very, very bright future. I don't see the globe easily transitioning to green energy or electric vehicles without using a lot more natural gas. And Chinese utility companies and their power plants should have already switched over from coal to natural gas many, many years ago. It should have already been done. It was not done. It was bad central planning, which the Chinese claim they're better at than the US. Honestly, I don't think they're any better at it really than the US is, except for maybe some of those bullet trains. But the bottom line is, if the oil and energy prices keep rising, that's going to mean higher food prices. It's going to mean higher cost of goods sold on a lot of items. So the manufacturing costs for a lot of Chinese factory owners, if they're actually producing things right now, is going to keep rising as long as energy prices rise. You can't say that China is going to be able to export deflation when their energy costs, their labor costs, especially their energy and electricity costs, are still going through the roof. Electricity costs, and I've seen interviews with Chinese factory owners, their electricity costs are up 10x compared to using electricity off the power grid in the past like they were with coal-fired power. But now there's a legit energy crisis and electricity crisis in China. There is panic buying by state-owned enterprises. It was ordered by Beijing. And you're seeing this with the prices of energy, of coal imported into China, of natural gas. Chinese state-owned enterprises are doing lots of LNG deals lately. Just in the last couple weeks, you can search it, China natural gas deals or China LNG deals. There's going to be a bunch of articles coming up in search. And this is a bright, bright future for natural gas. So if the natural gas price does crash, I think it's a buy the dip opportunity. I think natural gas has a very, very bright future, especially on the demand side. And the shale gas byproduct was one of the largest sources of cheap supply. A lot of that supply is offline, and a lot more other LNG supply is a lot more expensive than that heavily subsidized, unprofitable shale gas byproduct that was wasted since 2008. So there was an enormous amount of shale gas byproduct that was wasted between 2008 and 2019 before the pandemic. For oil, I think we could get another big pop in oil, but if oil does go to triple digits or substantially above that, It's going to wreak absolute havoc on the real economy. It's going to cause even more stagflation and shrinkflation. It's going to cause even more higher cost of goods sold. We're already seeing a lot of people complaining about higher gasoline prices. In a new poll here in the United States, it was showing that almost 90% of people polled were worried about inflation and it will affect their voting in the next congressional and presidential election. So the bottom line here is that there's a lot of evidence that China is panic buying coal, natural gas, and oil. And if natural gas and oil prices keep rising, they're going to wreak havoc on the real economy here in the West. It's going to be an absolute nightmare if energy prices keep rising. And energy prices rising acts as a tax on the real economy. It will be very similar to if the Federal Reserve actually raised interest rates a couple times.